Okay, welcome back to the Beat the Odds at Business and Wealth podcast. Trevor?
Hey, how's it going today, Josh? I think we got a really good podcast coming in. Going to be talking about all the good things that are going on in Canada. So what's the title for today?
Canadian Emergency Refinance Opportunities. There's moments in time where you make decisions and they have really small impacts on everything that happens in your life and in your net worth. And then there's moments and times where you make decisions and they have a very large impact, right? And that's kind of the dichotomy. It's like we think that they're all the same. It's like, no, some will matter much more. And a lot of Canadians are going to make a decision this year. And they're going to make them for all the wrong reasons and miss a glorious opportunity of what's going to happen.
Right. So I think this year was the year that they had said there's going to be so many mortgages that are coming up for renewal, and people are going out there. Banks are being very aggressive on renewals, and so are all the private lenders as well that I work with, being a mortgage broker myself. So let's we'll probably talk a little bit about that today. What are some other things? I think the projections that you had posted yesterday were pretty good, but let's start where you want to get to.
Well, first of all, happy birthday.
Oh, thank you.
Happy birthday, Trevor.
Appreciate that.
So Trevor's birthday. So all you clients out there who can't make your videos for whatever reason, shame on you. We're here every week. So I don't know what you guys are doing. So
every week,
make your videos. You got a business, you're sitting there in a silo. Nobody knows you exist, and you're not making your videos. So
got to wait till the conditions are just right. I'm not feeling it today. I'm a bit
I didn't like how my hair looked in that video.
Yeah.
That's not real stuff.
Don't post that one because I didn't like it. Tough. Let's just go. This is live. We don't get re-edits. We don't get do-overs.
Yes. Yeah.
I mean, we can delete it, but that's about as far as we can go.
Then we'd have to do another one. Jeez.
Right? Yeah. So, anyways, thank you so much for that. Appreciate it, man.
Okay, let's start off with our new favorite person, and we've agreed on this podcast that we will only refer to him as Mark Carnage. His name is Mark Carnage, and I will provide no further explanation on that. If you want, you can Google it and find out for yourself, but Mark Carnage will be the name. So, okay, let's see what Mr. Carnage, your friendly globalist banker, has to say about what's coming up for Canada. So.
And something that my government is going to do is to use all of the powers of the federal government, including the emergency powers of the federal government, to accelerate the major projects that we need in order to build this economy and take on the Americans.
Wow. Rah. We were talking in the break, Trevor, about, I learned in social studies that at one time the liberals were the party of weed and free love, and now they have become the party of emergency authority. So
only thing that's going to solve our problems and fight against the Americans is authoritarianism.
More emergency authority. Some of us,
as Arnold Schwarzenegger said, "F your freedom." Authoritarianism is the way to go for Canada. Beat the Americans.
For most of you, some of you in T4 jobs, you might not know, but I would say a rather large percentage of the business community is still dealing with the past emergency authority that was granted on the federal government, and a lot of those businesses are no longer with us. We have far less businesses than we had going into the last round of emergency authority than we had coming out of emergency authority. But let's do it again because that's what's going to work, right? And so,
worked so well last time. We're going to do it again. And you know what small business startups are? There's a lot fewer than there were, and a lot fewer self-employed people than there were before the scamdemic in 2020, 2021.
Yeah. So let's look through and how that, what are we talking? We have the Bank of Canada interest rates here. Okay, so the Bank of Canada interest rates. We're down now to 3%. Okay, we are down now to 3%, and Bank of Canada is going to come out 8 times a year. Watch those rates because this is the point where one person comes out and tells the rest of the world how much of our fake Zimbabwe dollars are worth anymore, right? So at some point in history, we're going to look back and realize that was a ridiculous idea that someone gets to come out 8 times a year.
It's almost like Punxsutawney Phil in Pennsylvania there.
Yeah.
You pull out the groundhog and it tells you you're going to have 6 more weeks of winter.
That's right.
Not.
We just leave it up to the groundhog,
yeah,
right?
It's up to the groundhog.
That's let's just leave it up to the groundhog. So the groundhog's going to come out and tell us how much our money is worth. And this is the game that we're playing. So, but, rather than complain about the rules of the game, we have to learn how to play the game, right? And this is what that podcast is about. So they come out 8 times a year, and the powers that be are going to be talking about emergency powers, and whether they win or lose the next election, it's like it doesn't matter. That those voices will be there, and that main group think in the government is like they're going to move kind of in a similar direction, right? Even if the Conservatives win, there's going to be an underlying pressure to spend a bunch of money, okay? And it will probably be blamed on Orange Man.
Yes.
It probably blamed on Orange Man, but in reality, like, it wasn't very good before Orange Man, right? And that's the next slide here that I have for is like, this is the number of jobs in Canada, and you can already see it's like, Trump was having no effect on the Canadian economy, certainly in December, right? Like that's not a Trump effect, but you can see we're down in private sector jobs from a high of 13,800,000 private sector jobs. So, we're now down to 13,400,000 private sector jobs.
But look at the public sector jobs.
Oh yeah, we grew by 300,000 public sector jobs, right? So we had one of our glorious CRA agents in our office yesterday. She was actually very nice, she was doing her job, auditing a great small business owner because they have nothing better to do. They get audited. So, but
I'm not sure if this is true. I think the numbers are right, but I believe there are more CRA agents than there are people in the military. So there's that.
I think that's true, but that might be, I have a warped perspective. Certainly I hear from more CRA agents than I do from military officers, but like certainly that's my line of work. So far. Oh my goodness. So far. Yeah. So things were not looking good into it. And sometimes the spin, it's like, if you have a villain, you can put the villain on the, it's like, it's because of Trump. It's like, our employment market was not very good, prior to Trump, so maybe that's the real emergency, right? Mm-hmm. But certainly some more power will get us out of that. And so, we'll move along in kind of the next supply there. And so what do those emergency powers ultimately mean? An increase in the money supply. Emergency powers ultimately mean an increase to the money supply. And so you can see, just stick up that chart one more time. If you can see that rate, that curve that goes up here, that's the last round of emergency powers. So I want people to it's really hard, but you need to make the disconnect in your head. It's like what emergency powers really means, and this is my pessimistic worldview, but I think it's realistic. It's like what emergency powers really means is we're going to print a bunch of money and steal your earning power from your future self and give it to you now in hopes that you won't complain so much, but everything else is going to cost an extraordinary amount more later. You're not taking it from the rich people and giving it to the poor. You're taking the average working class citizen's earning power from the future, giving it to them now, and then everything is going to cost more, and it won't cost more proportionally either.
No. Vote for Mark Carnage.
Yeah, right. Vote for Mark. That is what emergency powers mean, and whether we get full-blown Mark Carnage emergency powers, or whether we get a watered down response from the conservative government, if they come to power on this is what we're going to do to assist. That's what that assistance means. The government can't give you anything. It doesn't produce anything at this point. All it can do is take from your future self, the earnings from your future self, give it to you now in hopes that you won't complain too much and you'll elect them and they'll get to their year 5, they can collect their pension. It's like, that is the goal of this thing. That's the economic incentives that we set up. It was really interesting when last week we had Mayor Kim from Vancouver, and he actually said it. It's like that, you could see the underlying. It's like we have set up, and me and you have talked about that before. It's like that's the economic incentive we have set up for our elected officials.
That's right.
We
that's the carrot.
We only reward them if they can get stay in power just long enough to get their pension.
That's right. I mean, look at the example that's been set the last, 4 years, is we've been held hostage. Government hasn't moved forward. They've been acting like a pseudo majority government because they're propped up by the NDP and Jagmeet Singh.
Yeah.
So that's kind of caused us why we are where we are today. Normally, minority governments don't last this long.
Yeah. And so that is, when you hear emergency powers or assistance, what that actually means is an increase to the money supply. Okay. People need to retranslate that into their brain. Okay. That they're going to take earning powers from your future self, inject it into the economy now. Prices eventually for everything will go up, but they won't go up proportionally either.
And then also think about what happens next. So what happens with the rich people? So the money gets transferred from the person who gets the stimulus.
Yes.
I have stimulus. Look at all the stimulus I've gotten. I'm going to go buy some stuff. And then it transfers wealth to the people who already have desirable assets, goes in people who own stocks, people who own real estate, people who own companies. Like, that's where your stimulus goes.
A disproportionate amount of that new money always ends up in desirable assets, because people who already have what they need, they don't need more gas in their car, they don't need more groceries on their table. So when they get money, they're going to put that money into desirable assets. They're going to put it into real estate, they're going to put it into the stock market, they're going to put it into gold, and they're going to put it into Bitcoin. It's like that is what's going to happen here. Okay, so it's just, to what degree we don't know yet, right? To what degree is it going to be full Mark Carnage, or is it going to be bring it home, Pierre Poilievre? We don't know, but the money printer cometh. Like, that's what we do know, right? Like, it's one of the two flavors, but it's coming, okay? And people would say it's like we're going to cut our way out of it, right? Like, I just want to
cuts.
First of all, like, here's the U.S. It was even more dramatic on their increase of their money supply. It's like, look at this wild curve here, right?
That's not a curve. That's almost a straight line. It's almost like
that
God
is an
candle.
illegal curve. That is definitely a 2-minute penalty. Like, that's
M2 money supply here. God candle right there. That's what that is.
Yeah. Unprecedented, victorious. Like, it was and like, people want to say, like, you might not want to admit that, but that's the Trump administration.
Yep.
Like, that is
That's
Trump
true.
administration.
That's
so
true.
I mean, so for all of you think out there that Trump is some sort of fiscal hawk, like, and I want to bring that up too, like the whole Doge. If we had Doge, you know what I mean? Where's the Canadian version of Doge? Like, Doge is going to pull you out of it. It's like, here's Doge. U.S. debt counter clock now. $94 billion. Good job. Like, I mean, that needs to get done. Well done on that. But perspective is important
in 3 weeks,
here.
3 weeks, like, that's pretty good.
Perspective is important here. Where would Doge have to get to in order for the money printer not to come? Where would Doge have to get through, right?
Where does Doge need to be?
So we were just doing some rough back of the napkin math here. It's like, you have to understand, like, here's the gross domestic product. We're going to round it here. $30 trillion is the size of the U.S. economy. $30 trillion, because what's 350 billion between friends? So it's 30 trillion, right? It's $30 trillion. Okay. Now, how much can you realistically grow an economy? Okay. This is the growth rate, the U.S. GDP growth rate. 3%, last quarter they're 2.3%. Growing an economy by 3% year over year is like, that's actually kind of hard. Like, that's actually that's a pretty darn good outcome. Like, growing an economy by 3% every year, pretty good. Okay. So realistic expectations on a $30 trillion economy at a 3% growth rate, you're talking $900 billion. Okay?
900 billies.
$900 billion. Okay, so what needs to happen for Doge to be effective? For Doge alone to save the day is this number here, this Doge savings needs to go from, it basically needs to reduce this budget here from $2 trillion. Like, you need another $1 trillion off of that. Another $1 trillion off of that. But here's the paradoxical problem with cutting that out. A lot of that $1 trillion is actually in the GDP. So if you stop paying people to do these useless jobs or useless projects, that number itself is in the GDP. So you're actually cutting away from the existing GDP. So
Wait
it's
a
like,
minute. Are you telling me that the fronts for the cartels and the triads and so forth, they actually pay taxes?
yeah, some of those laundromats and nail salons, they're paying taxes. Like, that's just kind of how it works, right? But I mean, even the less nefarious ones where, you know, someone actually has a government job pushing a pencil around and they're doing something. It's like those people are paying taxes too. So if you take it and they're buying stuff in the economy too, you lay them off and like they can't buy stuff.
yeah.
So as you cut in, you know, as you make expenditure cuts in those, you put downward pressure on the 30 trillion here. And so, you know, does that have the potential for the one and done to, you know, to fix everything? I suppose. Is that likely? Not really. Not really. It's like as I told Mayor Kim on, you know, last Friday, it's like, I don't think the Vancouver Canucks are going to win the Stanley Cup. Like, I don't think it's going to happen. Could it? It could happen. Probably not going to happen. It's like, it's probably not going to happen. That's probably not the likely outcome of this story here. Is in what's going to happen is the money printer is going to turn on theirs. This wasn't a slide. U.S. reverse repo market. Oh, we're doing a live search here. So,
yeah. All right. Okay, so explain to everybody what this is. The reverse repo market.
Essentially the liquidity in the U.S. market. And you can see it's gone. For crude explanation here, this is a savings account, so the banks. Okay. If the banks don't have any money, they can't lend out any money. The economy as we know it kind of freezes up. And so what's going to happen is the U.S. government, you know, they're not going to balance their budget tomorrow. And so they need to be able to borrow money. And so they're going to have to inject liquidity into that system via the central bank, and like the money printer cometh. Like, that is the likely scenario here. And when you're on the Canadian side, you have more turbulence. Like, I think the market kind of understands more on the American side what's coming here. Okay. But on the Canadian side, we're just stuck in, Orange Man's crosshairs, and like he's just living in everyone's, like, I could just see him like living in everyone's head rent free. It's almost like comical whether you like him or not. It's like I don't understand the fascination of it. It's like we have highly desirable assets in this country, whether it's gold or oil and gas and potash and uranium, and we're somehow like being held prisoner by one country just because of proximity. When we could sell this stuff anywhere in the world, it's just highly valuable. So it's just,
we could, but we don't.
Yeah. Let's try to get ourselves out of it by having a trade war, by an economy that's 20 times our size, and see if that works out well for us. Like,
that's like a Chihuahua having a tug of war with an elephant, because we're snow Mexicans according to people in the United States.
Yeah, it's like Costco having a problem with the abusive customer in the customer service line and banking their whole business on selling more stuff to that person instead of just getting more good customers to come through the door and sell to them. Like, it's just it's completely bizarre, right? But it seems to be what we're focused on, right? It seems to be what's going to be the tariff response, as opposed to we're a business. And they're one customer, and we've got ourselves into the situation where they're too big of a customer. And rather than fix the situation, let's continue down that abusive relationship.
Yeah, this reminds me of conversations that we have with our clients. Okay, so when we do business coaching, business consulting, and you on the CPA side, and they come in and they have a sole source contract either with the government or just one company. Like they don't have more than one or two major customers. A lot of times just one customer. And the danger, the fear of that is, what if that one customer changes their mind one day? Somebody else takes over management, or they close their doors, or whatever. You put yourself,
they die.
Or they die.
They die. The person you're dealing with, they're great. Your relationship's great. Nothing's going back. Like, we've literally had this. And then all of a sudden, the person you were dealing with at that other organization just dies one day out of nowhere, and your business goes to zero.
So, I mean, put that in perspective, the same kind of scenario with the United States. So the United States is our major one purchaser of our raw materials. and they're irritated because of other things. Of course, there's drug problem and the border problem, but still they're our only customer, and we haven't had the foresight and the will to actually put pipelines across this country so that we can sell to the world.
We're not even selling to the other provinces
Right.
effectively. Never mind the world.
know, right?
Yeah, we're not. We have people in Eastern Canada buying Saudi oil when we have we have more oil in Alberta than the entirety of the U.S. and we have people in Eastern Canada buying oil from Saudi Arabia. Like it's just like it's so bizarre that that's how we've got ourselves through there. But
Anyway, I derailed you. Where are we going?
Okay, so we look at that. We look at the reverse repo market. And so what are the average Canadian? There is a plethora of people looking for refinancing options right now. And what they don't understand is like we're going to go through some turmoil. Okay, we're going to go through some turmoil. I'm going to pull up the TSX here. Recent memory. It's like, here you go. Like, let's look at 2015, big plummet in the oil market. That's a big dip here. Okay. We have COVID, big dip here. We have the financial crisis, big dip here. Mm-hmm. The probability that we have volatility is high. Like the probability right now that we're going to have volatility is high. But as an investor, as someone trying to build long-term wealth, volatility is your friend. Mm-hmm. Volatility is your friend, and eventually it's inevitable. Eventually there's a black swan event that creates more panic, and people react in either direction unreasonably. Mm-hmm. When things are going bad, they oversell, and things are going good, they overbuy. That is just what happens. That's just human nature. It's the stampede mentality, right? Mm-hmm. It's just like you get the group of animals who all run over the cliff together. It's like, unfortunately, human beings are.
All right. What's the black swan event going to be? Monkeypox or murder hornets? Which one?
I think it's just government craziness.
Okay.
I think it's just like good old fashioned. Here's free stuff. Please vote for me. I think that's the likely event. I mean, what's the catastrophic event? The catastrophic event is the meltdown of the U.S. financial system, not the Canadian one. Like that's the catastrophic event, right? And that's always a possibility when they're effectively broke and getting more broke by the day. So so that is always it. But like most Canadians, like they don't know how to capitalize on it, and so like what are they doing is like. They're trying to refinance their homes, right? Mm-hmm. Their biggest asset that most Canadians have, they're trying to refinance their homes, mainly their rental property, and they're going to go on to, best mortgage rates in Canada.
Ooh, yeah.
And they're going to look at, what's available, and they're going to say, it's like, man, on my 5-year, I got to get my 4%, right? And of course, like they're probably dealing with a rental property. They're going to find out that the best rate available in Canada is not on a rental property.
No.
And then they're going to be like, well, what about my acreage out? And it's like, no, the best rate in Canada is not going to be available on your acreage 3 hours away from any major city. Like that's not how this thing works. You got to pay people for the risk that they're taking. Right?
Property is a big factor when it comes to getting financing, and not all the banks will finance acreage properties or rental properties and these types of things. So.
That's right. And so they think that the rate is the be all end all, right? They're thinking, I got a $500,000 mortgage, and that $500,000 mortgage, and I'm gonna fight over that 0.5%. It's that 0.5%. Whatever is the lowest rate, that 0.5%, right?
50 basis points is what we're talking about.
$2,500.
Yeah.
They're thinking it's the battle's about $2,500. It's like, no, the game is actually simpler than that. It's actually simpler. It's not about who has the best rate. It's who has the most, who can actually borrow money efficiently, especially in times of crisis, to buy desirable assets. Okay, so who has the most flexible terms of financing? So who has the HELOC ready to go? Even better, who has the re-advanceable HELOC ready to go? It's like that premium, you pay for that premium, but that's how you build wealth, is that flexibility in your financing. And so, that's when, the COVID crisis happens, you get this like major pullback here in COVID, and you get a certainty of, you understand that a Bitcoin ETF is about to be passed and it's imminent, it's coming. The U.S. Securities and Exchange Commission, when they didn't appeal the ruling in the grayscale case, like, it was coming. I knew it was coming. When the COVID crash happened, it's like the stock market's not going to zero. People are panicking, right? And people with flexible financing who I wasn't setting up my life trying to get another quarter point with some lender I've never heard of. Like, I just had flexible financing. And then there comes that moment with like steel in your eyes and ice in your veins, and you see the panic, and it's like, I'm going in. Like, I am going in, and I'm going in hard. And then you wake up 2 years later and you realize it's like, all this work I do every single day here, in and out, and client meetings, and 1,000 client meetings a year. And that's one little decision where I had flexibility in the financing. I made more money off of that than all of the other hours I put in the rest of my life for the, year or 2 years before that. Like that's it, right? And so this is an emergency call to people. It's like, you are refinancing. Most people don't know how to do this, right? Mm-hmm. And so there's going to be a bit of a learning curve. It's like, ultimately, this next slide here, this is the prime rate of interest in Canada, okay? And the prime rate of interest in Canada is going to average out at about 4.5%. So, like, most people here, like, what you're going to hear from this podcast is a readvanceable mortgage provides you a high degree of flexibility, okay? And there's a potential to increase your wealth, but most people don't know how to use it, okay? You're going to have to come to the bootcamp to learn how to use it.
Yes.
Like there's way more than we could cover on a podcast here, but ultimately this prime rate of Canada is going to average out to about 4.5%. I can average out to 4.5%, and you can see a couple of decades of that history. If you start looking out over decades, you're going to start to see 4.5% is the average, okay? And if I'm dealing with a readvanceable product, I'm probably, gone are the days where I'm getting a HELOC at prime less a quarter. You get a couple clients who got those things set up, and I tell them, don't ever cancel that. That's an amazing rate, right? Like, let's keep that going. We can't get that anymore,
because
right?
when leveraged properly, you're making good advances.
This is it. It's like, I know the prime rate of interest like ultimately goes to 4.5%. It's like, I know I can get, flexible products that are around 5%. Call it prime plus a half, okay? And if you know how to invest at 10% plus, it just becomes a money printer over time, okay? But you have to have that flexibility in your financing set up. So, step one is you got to get that financing flexibility set up. Step two is you actually have to learn how to do the investment strategies that are going to, unlock that for you. Yeah. And then every once in a while you get the glorious opportunity. I mean, like, there will be opportunities that have happened. There's opportunities that have happened in the past. They happened in COVID. They're going to happen again. They happened in the financial crisis where, we're going to be able to borrow at 4% on those readvanceable products. And we're going to be buying companies that have dividend yields of 8% or more. And these are companies that, did not cut their dividend in World War II. You know what I mean? Like, this is what we're doing. It's like, it's just like a gimme. It's like, please come here. This is the rules of the game that we created. It shouldn't be the rules, but that's what's going to happen. And the probability that we're walking into a situation like that right now with the chaos is high, is high, right? As a citizen, as a regular worker, it's like you want stability, right? As an investor, it's like, you just want the chaos. Like, you just want the chaos, and you want highly flexible financial products. Like, that's what you want, right? And people are walking into these refinancing opportunities thinking that a quarter point here or a half point there is more significant. What is more significant is they actually have flexibility in these investment products that over time we're going to borrow at 5 and invest at 10. And sometimes it's going to get more aggressive than that, where you're going to be able to go in hard and fast, but only those with the liquidity are going to be able to take advantage of it.
That's right. Now, we also have to take into consideration that most Canadians are programmed. We've been programmed to worry about the monthly payment.
Yes.
Right. So that's why, going from a 2-point something mortgage into a 4-point or a 5-point something mortgage, it kind of freaks them out, right?
Yeah, they're mad. Yeah.
Of course, right? So that's kind of where a lot of people are at right now. That's why they're focused on the rate. But when it comes, like as we're seeing, I don't know if you showed the slide yet of the projections of the major banks that's coming up.
Yeah, let's get to that. That one's super important. It's like this is like it's almost guaranteed at this point. We were talking last year, and I said like 2.25 is kind of the line in the sand. Once you get to the overnight rate, so this is the overnight rate of the Bank of Canada right now. This is going all the way back to slide number 1. That's today. That's the overnight rate to the Bank of Canada. Okay. And this is the various, the big commercial banks in Canada, their economists project this number. And I was telling everyone last year, it's like they're fixing into their, fixed rate mortgage. Like these things are going to fall. They're going to fall. They're going to at least mean revert. And I said, I was like, my projection. It's like my projection is like, and there's no certainty in these projections, but it's like if I was gambling over under, it's like it's going to mean revert below the historical mean. Like that's the likely scenario here, that it's going to mean revert below. But now you're at the point. It's like now what I'm saying is no longer even contentious. Now you're seeing that all the big bank rates, it's like, so basically that overnight rate would be 2.25. You get to 2.25, your prime rate now is about 4.5%, 2.2% over that, maybe 4.45. Let's just call it 4.5. It's like, that's the historical average for the last 30 years in Canada, right? But now you're starting to get some major financial institutions who their projections are the same as mine, the 2%, right? And if you go further into some of these banks, they already have, in the event that there's some tariffs, it could be 1.5. That's their projection, right? So they're already starting to qualify to the low side, But meanwhile, Sally down at the RBC is telling you that this mortgage is 4.5 instead of, this mortgage is 4.25 instead of 4.5. This is the one you want. This is the one that's going to make you rich. It's like you can keep, you can keep Dave Ramseying your rice and beans and save up and pay. It's like, no, I just want the flexibility. I'm going to go in, when there's blood in the streets, you're going to go in hard and fast. And that's when all of a sudden you just get the opportunity where the odds shift in favor of the blackjack player. There's certain hands where the odds flip in the favor of the blackjack player and away from the casino, and that's when you have to take the house down. Like that is when it happens. But if you do not have flexibility, it just does not happen that way for you, right?
Yeah. Well, just like Warren Buffett, the Oracle of Omaha, be fearful when others are greedy. Be greedy when others are fearful.
Yeah.
We're coming into that kind of event. If you look on that chart, though, Scotia's richer than you think. They're not going to change their.
I don't even know what they're doing there. Like maybe they don't have maybe they've decided not to employ any more economists or something. They're just like, it's 3% now. It'll be 3% tomorrow. It'll be 3% forever. Like I don't. Sure. I'm not even sure what's happening at Scotiabank. So
I wonder what your insights are on this, because like, the majority of Canada, or not the majority, but a big portion of Canada's GDP is basically just trading houses between each other, which is really affected by the rates and people being able to qualify for mortgages, more new mortgages, or just transfer switching. Like, does this have something to do with that fact that our GDP is mainly tied to real estate?
I mean, yeah. I mean, certainly, like real estate ties into the projections for sure. But like, in order to get cooking on real estate, you don't just need rates. You need to be able to get approvals for the properties. You need to have the workers who can actually build it, and then you can actually, get the funding. So it's the rules of the funding that are available too, right? And we started to have some rules, contemplated rule changes about, secondary suites and extra loaning for secondary suites. And it's like now, we have a government that's completely shut down and prorogued, and no one really has any clarity of what the heck's happening, right? And so we're just getting chaos. And so what's the action item for the regular citizen now is to have maximum flexibility in your real estate financing. Maximum flexibility. Because ultimately, if you own a piece of real estate in Canada, it's like we teach people this at the boot camp. It's like the average rate of return is about 6%. That's the average appreciation on real estate in Canada. That's what it's been for the last few decades. And it's, it can be very different, if you're in,
Saskatchewan.
Yeah. If you're in Lloydminster, Saskatchewan, right? Or Lloydminster, Alberta, right on the border town there, right? Like, if, you're probably not going to get the same rate of return that you're going to get in West Vancouver. And so, but ultimately, the reality for most Canadians is your real estate going to keep up with an ounce of gold, the real rate of inflation? Like, is it actually going to keep? Probably not really. The only way to actually move forward in terms of ounces of gold is to actually structure your debt efficiently. And so when you have a piece of real estate, you have two assets. Asset number one is the real estate, and asset number two is the debt, okay? And it'd be like saying just because this house is cheaper than the other house, that the cheaper house is the better investment. Not likely, okay? It's the same with your debt instrument that you're attaching to the house. If one debt instrument is entirely inflexible and the other debt instrument has mass flexibility that you're going to be able to structure your capital life into a more efficient means, if you're going to be able to extract the equity at 5% and deploy it into whatever vehicle that you can find that you can do 10% or more, as we teach in the boot camp, it's like all of a sudden you flip it in your favor, right? And so that is the action item. You're coming up for renewal. It's like you need to learn about how these strategies affect you. That's just what we teach at the boot camp. It's like, all the things about money and wealth where, I tell people, they didn't teach me when I got my business degree. They didn't teach me when I became a CPA. It's like, this is actually the game that we're playing here. But the action item right now is like, you want debt with maximum flexibility. A mortgage product with a readvanceable HELOC on top of it is more expensive, and I'm more than happy to pay for it because I'm going to take that money. I don't care about the 0.25%. I'm going to take that money at 5%, and I'm going to grow it at 10% or more. And that's essentially the game that we're playing.
That's right, folks. So that's it for the podcast today. Thank you so much for joining us. Don't forget to get your tickets to our upcoming boot camp. It is on May 11th, I believe, and it's at West Edmonton Mall here. So travel. Like, we've had people come from the United States, from all over Canada, just to attend one of these in-person boot camps. You'll have 8 full hours of Josh teaching you about the history of money, how money works, how debt works, how to lever it up. And if that's something that interests you, come check it out. Again, get your tickets today, and we'll see you at the boot camp. All right?
Right on, guys.